Welcome to this video. So we are going to look at Nancy Pelosi's portfolio. We're going to run it through the real risk terminal of IBKR, and we're going to find out exactly how much of a crash should we need to experience to receive a margin call. Now, I've taken our portfolio from something I found online. You can't get the exact cost basis, right? But I can reverse engineer it from the information on here. So I've put her entire main holdings, her Google, Amazon, Apple, Microsoft, Nvidia, Broadcom, Visa, Salesforce, Palo Alto, Alliance, Bernstein, CrowdStrike, Netflix, American Express, Vistra, and Comcast. I've not included her other portfolio section. I don't know what it is, but it still gives you an idea. The portfolio should be worth 137 million. What I've processed is roughly 77 net, gross is 97 million. So here we have the portfolio. Now, Nancy is not playing the buy, borrow, die framework because, honestly, this is a good video because it's going to really show where people get the buy, borrow, die strategy wrong. Because what can actually beat the strategy is just a solid, high conviction investment portfolio. And the strategy of holding stocks for longer just gets proven time and time again. Now, I'm going to have a look here at our portfolio. So she has one of our strongest holdings. Look at Visa, right? She bought Visa and her unrealized P&L on it is 4.4 million with a gross value of 4.6. So she nearly enough put 200 grand, 160 grand, and she just held it. And it's, 4.4 million in profit. The same applies to Google. Google is actually her strongest unrealized P&L from my calculation. 14.6 million in unrealized P&L. And the same goes for Apple. Apple's got 10.5 million with a gross value of 11.1. So again, just huge returns. Just holding monopolies. Now, obviously, this portfolio gets operated more like a hedge fund than just a buy, borrow, die portfolio. And she does do a lot of leap options. But I just really wanted to show you if you was to borrow against the portfolio, what sort of crash would need to happen. And what's great about this framework, what we're looking at right now, you're looking directly at the source code of Interactive Brokers Risk Navigation. The risk terminal is great because it shows things that most investors are blind to. They don't really know how really exposed they are, and they're sort of flying blind. Whereas we're looking directly exactly how the broker decides the risk of the portfolio. So they've given her a maintenance margin of 15 million and estimated shortfall. Yeah, so if you look at this is the broker is basically 99.5% confident on the worst case scenario. On a terrible day, the most the portfolio would crash by is 6 million. So they're saying this is as bad as it should get, which is kind of tiny, to be honest, in comparison to the size of the portfolio. Yeah, so that's the estimation. What I've done here is I've already taken a margin loan out. Okay, I've just took out 20 million. That's roughly 20%. Yeah. And we're going to say, how much does the market need to crash for her to get a margin call? Yeah, that's what we're going to look at. And the biggest challenge people have with doing buy, borrow, die is because it's a wealth preservation strategy. Because it's a wealth preservation strategy, people tend to over-diversify the portfolio so much because they just want no volatility. And as long as there's no volatility, they're happy and they keep borrowing against the portfolio to avoid capital gains tax. The problem is you end up actually just bleeding slowly and you're just paying more in interest, because you need to have some sort of growth. There needs to be growth there. I've made many videos in the past. The S&P 500, it has outperformed inflation for maybe 12 times out the last 20 years. So it can do it, and it's doing it this year. But it is a coin toss. We can't rely on a coin toss for a wealth architecture. You have to have a strategy, otherwise you're just flying blind. I'm going to show you here. Now, IBKR is probably one of the strictest brokers. So it's going to make it very interesting to show you how they view the risk or the volatility of this portfolio. So here we have it. On here we've got the weighted beta. It's basically looking at all the positions and saying how volatile they are. Most investors just maybe look at whatever the beta score is on Google Finance, Yahoo Finance, or wherever, and just sort of guess. Most brokerage platforms are not going to tell the investor what their expected shortfall number is, what their weighted beta is. But here we can see the weighted beta for Pelosi's portfolio is 1.36, if you can see that. And really, to make it simple, really simple, 37% more volatile than the S&P 500. So straight away, you can actually just do the calculation manually. Straight away, I can just look at that and say, okay, for this portfolio to get a margin call on borrowing $20 million, the S&P 500 needs to crash 55%. To keep in mind, the last time it probably did that was in 2008. It didn't even crash that hard during COVID. Yeah. So you're talking roughly a 76% crash. Yeah, so hold on. I'm putting the cash back down. Yeah, so look. I didn't know who the other stocks were, so I just put it in as cash to get up to the 137 million. And the maintenance margin will stay the exact same. This is on portfolio margin. So really it gives massive breathing room. The initial margin is only 16 million, which means there's so much leverage available there. Yeah. So her actual unrealized P&L on the main positions is just over 66 million. So average cost I calculated is 30 million to give a gross value of 97 million. Yeah. And just holding these positions for so long, they're the ones with the most gains. This is what we're saying, this is what I talk about so much on the channel. The more you're willing to hold a position, you are the unrealized profit and loss just goes higher and higher and higher. The compound growth just gets exponential. See, a portfolio like this has truly reached escape velocity. So the portfolio grows faster than the cost of human survival. That's the way I look at it. Once your portfolio is at escape velocity, there really is no reason to sell. The structure is in place, and it's now the portfolio grows faster than your human labor could ever keep up. So there we go. I've got the margin call calculation. So really you're talking 76% it would need to crash by. And margin call is triggered. This is on her borrowing 20%. So the portfolio would need to get wiped out from 97 million all the way down to 23 million. So roughly S&P 500 is crashed 55%. Boom, margin call. Now with IBKR, there is no margin call. It's just automatic liquidation. Auto-Liquidation. And look, she doesn't really even have defensive stocks. Really, there's maybe Visa. You could argue Visa's defensive. Alliance Bernstein or Alliance AB, that's defensive. American Express, and she's currently down on Vistra. But honestly, the way we are now in this modern era is, I would argue that companies like Google, Apple, Microsoft, these companies are defensive in the form that they can't go bankrupt. It'd just be impossible. They're practically sovereign digital nations at this point. But of course, there's still volatility. We can't control Wall Street's panic. Wall Street pretty much decide the market. They decide if the market's going to panic or not. That's up to them. Retail investors, we have absolutely no really much control over large cap stocks. We I think 85% of the movement on the market is just done by Wall Street. So we can't decide what mood they're in. So if they want to just sell out on Google stock, we can't stop that. But as far as actual, risk of Google going bankrupt is pretty much zero at this point. These companies are now making more than nations. Like I think Nvidia is worth more than the GDP of pretty much every country in the world except China and the USA. So yeah, I just, as far as can they crash? Could this portfolio crash 76%? I guess you have to say anything is possible. I mean, it would have to be a 2008 style crash. It would have to be a really bad crash. And again, you'd have to assume that she didn't put in $1 of cash as well, just sat and watched it crash, just watched the ship go down, didn't deposit any cash. Because again, a crash like that I don't think it happens that quickly. You don't wake up one day and the market's down 55%. Yeah, so the risk algorithm, they are saying they're 99% confident a bad day is 6 million drawdown. So you can see the full portfolio. We're off market time, so nothing's moving right now. I think it's just based on the P&L off the Friday, the 29th. So it was up 1.1 million in a day. So what the point is, the portfolio, I mean, this type of portfolio is probably will sell stocks. And if you're up so massively on a stock, then I would not be the person to say, okay, you can't sell it. But because the game's already done, this kind of portfolio doesn't really care about capital gains tax because the growth, the velocity is so violent. If someone's bought Nvidia a couple of years ago and they're up like thousands of percentage, you're not going to really worry about capital gains tax at that point. But at the same time, the compound growth for the companies that are held the longest is just exponential on, in this case, Apple, Visa, and of course, Google. Yeah, so again, when we're looking at individual stocks, if they're monopolies, then these can just be held. They can absolutely be held, and just the compound growth just continues on and on and on. So don't be afraid of a bit of volatility because you do need that for the growth. I know it's the byproduct wealth preservation, but at the same time, you've got to have some sort of structure in place where you have growth stocks and ETFs. And the great thing here about the weighted beta, it tells you exactly what stocks are responsible for most of the volatility. So on this portfolio, it's of course Nvidia, Broadcom, Google, and Amazon make up the majority of that volatility. Because what it's doing here is it's actually factoring in what percentage of the portfolio that stock is, and it's doing a calculation. So you're getting a actual view of how the algorithm calculates based upon the position size, the exposure. It's doing the actual maths behind the scenes. This is not something that's usually showed to an investor's portfolio, so they really actually might not know what their weighted beta is, so don't really know how exposed they might be. But yeah, there you have it. So the general rule of thumb for me, margin for lifestyle, 20% borrowing. If we're but wanting to buy more stocks with debt, we could perhaps look at a Lombard loan from another facility, split the portfolio up if you want to, if it's worth it. Totally depends on the investor's appetite. But there you go. Margin calls are not as terrifying as you need to believe. Yeah, so you don't just wake up one day and your portfolio's gone. You know, for me, this is obviously like a hedge fund level portfolio. There's just not a lot of defense protection in there. So for the average investor, they can have some growth stocks, maybe a growth ETF, and some defensive stocks just to calm it down, because then we can actually look at the weighted beta. You see, so we can just plug the stocks into the portfolio, and then we can just calculate straight away how much the S&P 500 needs to crash. It's that simple. You know, this is information that's so vitally important to know before you start, borrowing for lifestyle, because otherwise you're just flying blind. So I'm going to make more of these. I like to break down real portfolios so we can actually look behind the scenes and see their risk exposure and what would need to happen for them to get margin called.